Welcome to the TOEFL listening section. In this part, you will hear one or more conversations in an academic or campus context, such as a discussion between a student and a professor, or between two students. You may take notes while listening. Listen to part of a conversation. You will hear it only once, so listen carefully. After the conversation, you will answer questions about what you heard. Some questions will ask you about main ideas and details. Others will ask about implied meaning, speaker attitude, or how ideas relate to one another. Use both what is stated and what is implied to answer.
Good afternoon, Dr. Park. Thank you for seeing me during office hours.
Good afternoon, Aaron. Please sit down. What can I help you with about market bubble psychology?
I am preparing a paper on irrational investor behavior patterns that drive bubbles, and I want to make sure I understand the main psychological mechanisms.
That is a rich topic. We should look at common patterns like herd behavior, overconfidence, and extrapolation bias. Also, narrative amplification and feedback loops.
Could you clarify what you mean by extrapolation bias in this context?
Extrapolation bias is when investors assume recent trends will continue indefinitely. So a rapid price increase leads them to project ongoing high returns, which fuels more buying.
So that explains part of momentum. But how does herd behavior differ from simple momentum trading?
Momentum can be driven by individual heuristics, while herd behavior involves social proof and imitation. Investors often ignore private information and follow the visible actions of others, especially when uncertainty is high.
Is that where FOMO, or fear of missing out, comes in?
Exactly, when narratives create a story that an asset is unique or scarce. FOMO intensifies herding, and FOMO together create a positive feedback loop that pushes prices away from fundamentals.
You mentioned narratives. Could you give a concrete example of how a narrative amplified a bubble?
Think of the dot-com era. Investors embraced the narrative that the internet would change everything almost overnight. That story justified sky-high valuations even when cash flows did not support them.
And that is different from, say, the 2008 housing bubble. How?
The housing bubble had a narrative too. The story was that housing prices always rise, and that affordable credit made homeownership a safe bet. That belief, combined with overconfidence among lenders and borrowers, led to risky behavior.
Are there psychological biases that make people persist in bubbles, even when prices look absurd?
Yes, confirmation bias is powerful. People seek information that supports their belief in rising prices and discount warnings. Loss aversion sometimes paradoxically keeps investors invested because admitting a mistake is painful. They cling to hope that prices will rebound.
So overconfidence and confirmation bias act together.
They do. And add anchoring. People often anchor on reference prices such as peak values or recent highs, which distorts their assessment of fair value.
What about the greater fool theory? I have seen that term in several papers.
Greater fool theory describes participants who buy overpriced assets, expecting to sell them to someone else at a higher price. It is a classic behavioral explanation for speculative manias.
Does social media change the psychology behind bubbles compared with historical episodes like tulip mania?
Social media accelerates information diffusion and narrative formation. So rumors and success stories spread faster. This intensifies herd behavior and shortens the time it takes for a bubble to inflate and burst.
Are there empirical methods to detect psychological signs of a bubble before a crash?
Researchers use several indicators. Behavioral signals include spikes in trading, volume searches, and social media mentions. Excessive deviation from fundamentals, volatility clustering, and correlated ownership across investors are also red flags.
Can experimental economics simulate these patterns in the lab?
Laboratory asset markets have successfully reproduced bubble and crash dynamics. Students trade in controlled settings, and we see extrapolation herding and speculative buying. Just as in real markets, bubbles can form without fundamental news.
That supports the psychological explanation rather than purely external shocks.
Yes. It shows how endogenous feedback from investor beliefs can generate mispricing.
When bubbles burst, do the same psychological patterns produce panic selling?
Often, yes. Once price reversals begin, loss aversion and herd panic lead to abrupt selling. Pressure cascades form when liquidity disappears and everyone tries to exit at once.
What policy implications follow from understanding bubble psychology?
If regulators recognize psychological drivers, they can design macroprudential tools and disclosure requirements to reduce leverage and slow narratives that feed irrational exuberance. Education about biases and cooling measures in credit markets can help.
Should my paper include case studies to illustrate the mechanisms?
Yes. Use .com, tulip mania, and the housing bubble as comparative cases show how narratives, overconfidence, and feedback loops appeared in each. Then include modern examples like cryptocurrency episodes to highlight social media effects.
One last thing. When you said that narratives amplify bubbles, I meant that stories about innovation or scarcity change investor expectations and create self-reinforcing price momentum. Could you explain why you phrased it that way?
I phrased it that way because narratives alter perceived probabilities and motivate coordinated action. Narratives change how investors interpret signals, which makes prices move in directions that validate the story until the story collapses.
Thank you, that helps a lot. I will structure the paper around these psychological mechanisms and include empirical measures and case studies.
Good plan. If you want, I can review a draft and suggest empirical papers that measure social media sentiment and trading volume as predictors of bubble dynamics.
I would appreciate that. Thank you for the guidance.
Listen again to part of the conversation, then answer the question.
When you said that narratives amplify bubbles, I meant that stories about innovation or scarcity change investor expectations and create self-reinforcing price momentum.
This concludes the conversation portion. For more TOEFL practice tests and study materials, visit Spinta.org.